All righty, welcome everybody. Let's jump in. We're just going to do a live trading session today and do a little bit of training. Really, I want to open it up to questions. There's always questions in the Discord, and I could sit there and type and try to catch up and keep up with everybody all day, or you can pound a bunch in here, and we can try to knock a bunch of questions out if you have some, or if there's a topic that you want to make sure that I cover with you today. I'm going to just jump into my portfolio and I'm going to just start rocking through it here. And if you have questions along the way, I'm sure things will come up that you can ask. So let me jump in to the platform. You can see, so this is the Income Navigator account. On the session, we do not have any really new activity today. This was yesterday's. So you can see the two zero DTE trays and then the gold trade that we opened yesterday. So that was yesterday's trading, nothing today. So we haven't added anything. But again, like I said, yesterday, 2 0 DTE trades, both closed for 50%. And then we added a ratio spread on gold. Reason I did that yesterday, just to make sure everybody's on the same page as to what I do. And sometimes, there's things that I do that are not always in the easy to figure out, even though I try to explain them. Is I did a ratio spread on gold because it's just doggone hard to actually set up a 112 on gold. So it doesn't work really well because of the buying power on gold. 112s are really, really difficult unless you really start to crank up the naked puts to a much higher level and you shove the PDS down lower to cost less. So you got to put the PDS down lower and pull the naked puts up higher. And then that really distorts, in my opinion, the purpose of that 112. It doesn't really resemble much of a trade anymore. It actually really becomes, because they're so close together and sandwiched together, it does really become more of a ratio spread. So that's why I did that yesterday. If you have questions on it, I'm certainly happy to answer those. If not, we're going to dive in. Let's just rock and roll through the account. And first thing we'll jump into here is oil. Everybody knows I love oil, and I really like it right now. And make sure that I can see all of my screens. And if you want any charts or anything like that, we can go through some of that as well. Gold's up again a little bit more today. We'll talk about that in a second. Oil itself bouncing after yesterday. We're up $1 or so on oil. We've got a February 112 trade here sitting out there. Now, again, I will typically take off my naked puts at 95%. So we just hit those on the move today. So I'm going to look to close that position. Even though they're at a penny, I will never get a penny while trading that. I can always put it in, but I'll be surprised if that would fill. But it will fill at 2 cents there, which is totally fine. So we will take off these naked puts. Okay, in oil, so there's one trade down. We could also take off these short puts of the 112 piece here as well. So these can also be taken off. And you've got 15 days left. I can turn it into a long, put hedge. But I'm really not that worried about oil, so I'm not going to do that right now. I mean, it doesn't cost me a whole lot. It's going to cost me $80 to do it, but I really don't have any need for that type of a scenario since I've already taken off the naked puts. I feel pretty good about that particular trade. Now, the next trades on oil will be for this March expiration. Here we've got 112 trade on, where the naked puts are at 77, the short puts are at 73. There's really nothing to do. This trade's up 80% in 33 days. Nothing to do there. We've also got a ratio spread sitting out there, which is up 10% in just 4 days on this expiration. So there's not a whole lot to do there. All right, I'm going to try to keep my eye on chat here. So if I don't answer your questions in chat, somebody unmute themselves, just yell at me, and I'll pay attention. All right, Squeak, I'll get to that. Strangles. And I'll talk to you about why I'm still sizing them the way I do. All right, so nothing to do on this oil futures expiration. Now we have another oil contract here. Now we have a strangle running here. This strangle's up almost 40% in 20 days. It's not much different than 50% or so in 30 days. I could take it off early. It's almost $1,000 winner. I'll probably let it percolate just a bit more. Normally I would look for 50% in 30 days on these, which is a 1.67% a day. So if I don't get 1.67% a day, and again, Candy, if you want, you can let people in. Cool, I think you already did. But you get 1.67%, right? So if you take 50, you divide that by 30, that's 1.67% a day. So if I get more than 1.67 or 1.7% a day, I could look to take something off early. So what do I have here? I have 38% in 28 days. Take 38 divided by 21. It's 1.8. Instead of 1.7, it's 1.8. Yes, it's fractionally better. It's not significantly better. I'll probably just let this run for a bit on it. But and one of the reasons I'll let this run is if I went to put on another oil trade right now at 90 days, I don't have one because these are all at the 78s. I would be looking at the 107. Not saying it's a bad thing, but on futures like oil and gold, I really hesitate to go out much past like 95. It's a volatile type of an item. So they're volatile futures, whether it's copper, it's gold, it's oil, it's nat gas, which some of you guys are still trading, which is craziness. It's live cattle. 90 days is already a lot of exposure. 110 or more just really puts it out there. I'm not saying don't do it. I know plenty of people that do put those on there. I will probably wait a little bit. So if I'm not going to be able to put something new on for a few more days, maybe a week, I might as well just let this thing cook a little bit longer and squeeze out another 10% of this trade, which would be at least another $80 or so. You do have another ratio spread here. Now this ratio spread's up 34% in 8 days. Well, normally, again, I'm looking for 50% in 30 days on a ratio spread. 34% in 8 days. Well, my 1.7% a day. So 34 divided by 8 days is what, 2.3%? Okay, well, no, it's 4% a day. So I'm getting 4% a day on this ratio spread here. I think it's probably a good opportunity to actually close this one out here. So if you've already made 35% in 8 days, and 50% is my goal, I mean, why not take it off? I mean, 34 divided by 8 is over 4% a day. Okay, this is a pretty good trade. I don't need to do anything more. You could try to take this off. My only problem with ratio spreads is that I got a leg out of them, but I think that's something we can do here. So we may look to close this particular position out. I'll do this in a little bit, but I'm probably going to close out the April. I'll make some notes here. I mean, if you need to see me do it, I'll be more than happy to do it. And now I'm just going to make a note so that we can close this out afterwards. But the April 17th CL ratio spread, I'm going to close this here. All right, so that's a nice $400 winner. We'll take that. All right, we have another 112 trade here. Now this, I use the AT moniker right now to just designate that it's really more like a BA 112 type of thing, but the AT signifies that I moved the put debit spread up a lot higher so that I could potentially get into this trade on just a slight down move. You can see on this particular trade, we've been in it for only 4 days. The naked puts have already decayed almost 20%. That's pretty doggone good. And the put debit spread is already starting to, if we have a drop, yesterday was a good drop. This thing spiked up. Today we're up the other way. We're at $77, but we're only 3 points away from this trap. I love this trade version where I spend a little bit more money on the naked put, maybe like a 6 or 7 delta, which is totally fine. So 6 or 7 delta on the naked puts. It's a little higher than normal. I don't see anything wrong with that necessarily, especially when I'm used to doing strangles at 7 delta anyway at 90, and I'm over almost 78. I put this on at like 82 days, so it's close to a strangle. So I think putting it on at 7 delta is is okay here, and it pays for the fact that I moved that put debit spread up higher. And if we take a look at this particular one and how it looks. Okay, there we are. You can see that this, the entrance to the trap is way higher than a standard 112 would be. So we get a lot higher up on the standard 112. So any kind of a drop, in this trade, 2-3 points, puts us close to the trap, and we don't have to be in the trap. We just got to be somewhat close to it outside of here, and this should start to lift as time goes on. So as time goes on, you can see that T+0 line start to lift and lift and lift as this thing goes. And eventually, okay, as we get closer to it, this T+0 line, especially if volatility or something increases, this T+0 line, as it lifts, now I'm making money, okay, out instead of making my, 1,290 bucks here, I'm now making 2,400 bucks, and I'm still not even in the trap. So having a higher PDS allows us to maybe catch, if we're somewhere in this range, closer to expiration, that allows us to catch parts of the trap without actually being in the trap with that higher piece. In order to pay for the higher, I just go a little bit higher on the naked puts. All right. And then lastly, we have a strangle on oil that's only 4 days old as well. That thing's up 3% in 4 days. I'll take that. All right, so we're going to close this ratio spread out. Maybe we'll close it before the end of this session, but you guys get the point of why I would close this. 34%, 8 days. Why not take the money and run? And I can do something else with it. You know what? Let's go back to the strangle question here. And the question is, in my trade plan, I normally would size for 1% of net lick on it. So I'm going to pull out the trade plan for a second. And we're going to go to strangles. So give me a second to pull that out. Right, so here's the strangle strategy. I may go up to 6 strangles at all times, potentially. I will size the trade for initial credit of about 1% of net lick. So with my net lick being 415 some odd thousand here, obviously 1% of that is pretty easy to get to, but that's as much as I want to take in on a credit, because again, a 2x loss should only be 2%, right? So I don't want to lose more than $8,000 on this trade. I'm willing to put in 4,150 bucks worth of credit on these particular trades, but I am sizing a little bit lower than that in some situations, and I'll tell you why that is here. So that was the trade plan. If we look at the trade tracker and I go to my strategy builder piece down here and I look at futures strangles, right? When I decided to move to like a 10% allocation, that allows me to go with about $4,000 worth of buying power. I can take in about 600 bucks per contract. It lets me do about 5 contracts a month on different futures that I have out there. Okay, it's probably not really reflected as much in my trading plan as it is here, because this is more 10%. If I look at the trading plan, I did adjust it, so it's still 10% here. Okay, I can do up to 5 contracts a month, right? Well, if I did my full size on oil, if I wanted to put on an oil strangle here, and if I went and did a new strangle, let's just pick this and let's go here and put on a typical strangle, 60 somewhere around here-ish, something like that. Okay, so if I wanted to put this trade on, it's going to, I'm going to use about $2,000 buying power, make 770. So you could size this up, right? But my contracts are going to get to be too large if I try to do it all. Now here, this would be probably the size. It's somewhere between 5 and 6 contracts of oil. Okay, and would use about 13,000 in buying power. But if you remember, the trading account said use about 5 contracts on average, about 20,000. So if I did it all here, I would only be able to put strangles on in oil. What I've elected to do instead of that is I went to 4 contracts, which is a little bit less in this particular case, so that I could also put strangles on in gold or bonds at the same time. Does that make sense? Squeak, I think so. That hopefully that addresses your question on that. Is that when I look at this particular trade here, I could have done 6 contracts, but I would have used up pretty much all the contract and buying power on one strangle. So the reason I haven't sized it to my maximum, even as the account's grown, is because I'm only using 10% of my buying power, and I want to spread it out a little bit more. So I can't exceed 5 to 6 contracts. Okay, so that's my maximum, and I want to be more diversified. So I have, 2 strangles on oil here. I'd rather have these 2 strangles on oil, and then I also have some strangles down here on. There's one on gold. There's a strangle down here on bonds. I don't think I have a strangle. Yeah, and I have a strangle here on HG. So yeah, I do have more contracts here, but I've kept it under my size. So that hopefully that answers that. It just helps me diversify a little bit more. Can I size up one? Well, this was the problem it's a little bit of the problem dating back to the whole weekly strangle thing, where I was undersized a bit and trying to do a bunch, but I was taking them off early instead of letting them max out. Well, the problem here is that if you size up one too much, I can't diversify as much, but I want to let them all expire for 50% if I can. So there's a little bit of that. So let's take a look, and we'll take a walk down ES Street here and see. iPhone question. So I moved the PDS higher because I had less time to enter the trap zone. No, I moved the PDS higher because I wanted a higher percentage of falling into the trap. Normally, if you're putting one of these trades on, and if you put a standard 112, which is around 60 days, if I put a standard 112 on, I really start to look here for something around $7-8, which I know for me comes to around this 25 delta, $8. Okay, so $8 there, and then maybe down to 5 delta here, which is what I've been doing. But before I put that on, this PDS alone has a probability of profit of 29%. I don't even think we're getting that close to it. I'm going to remove open interest here. Okay, but I even look at the fact that this is 78% out of the money and a 25 delta. So really, I don't care that your probability of profit on this PDS alone is 29%. To me, it's more like 20%. And in reality, we in the bullish market, and I think everyone here would agree, we are in a bullish market on ES and NASDAQ, and especially on the weekly. So if you watch mine or you look at Candy's market profile, either one of us, I think we're in tune, except for one underlying. We're not exactly on the same page. Other than that, I think we're on the same page. I look at the weekly. The weekly drives my determination of to whether we're in a bullish or bearish trend. Oil being in a bearish trend on the weekly, bullish on the daily. But on ES, it's a no-brainer that this is bullish. So when you're bullish, this 25% chance of falling into this trap is probably closer to 20 or less. I mean, I don't even know that I hit the trap at 10% of the time. So what I wanted to do here on this trade, and I will go ahead and put this trade back on. Okay, let's take a look at this particular trade. All right, so if I was doing a 1-1-2 trade right now, okay, this would be it. Okay, this gives you a good sense of what this trade looks like. It's 60 days out. I get 575 extrinsic on 7,900. So 575 on roughly 7,951 is 7% in 2 months. That's pretty nice. We'll take that. So I think that makes sense here to do this. However, I only have on this trade, we're in a bullish market. We could get a pullback. I don't think we're getting a 20% pullback. Okay, I think maybe we'll get a 2%, 5%, maybe pullback to maybe the 21 EMA on the weekly or something like that. The daily is only like a 2% pullback, I believe. Candy might know on yours because then maybe you track that better. But just if I'm looking at SPY, for me to drop from 491 to 461, 30 points, okay, is a 6% pullback. So on the weekly, a 6% pullback in SPY lands me on the 21 EMA. Okay? So even if we pull back to the 21 EMA, which is a good spot for a weekly pullback to remain in a bearish mode, that's also exactly a pivot level on SPY. So I think that's a good level. That's only 6% down. I think if we drop 6% in the next couple of weeks, everyone would think the sky is falling, but really it's just a pullback to the 21 EMA and you remain in a bearish trend. We would have to have a series of lower lows and lower highs to switch your mode. So how do I increase my opportunity here to catch something in a pullback? Well, I can move this up a bit. Okay, I could also narrow it. But so let's say I go up to 48.90. What does that look like here? 48.90 is around the 30 delta. I think you could probably even go higher. Okay, maybe something like this. We could even potentially move higher, but okay, maybe we do something like this. Now, I'm getting 330 on 7,900, and that's no longer giving me the return that I need. So I will have to pull this up fractionally to get me somewhere along those lines. This down here, maybe 6. Let's go to 7-ish. Let's just go 4,500 because there's good open interest there. All right, so how does this look now? Okay, 575 on 9,400. That's still pretty good return. That's almost 6%. So 575 on 9,400 is 6.1%. Still fits my 3% a month on the trade. But what did I do here? Yeah, I took a little bit more risk on this downside by moving it up, but I only moved it up to 7 delta. It's not like I went to like 15 delta or 16 delta here. I'm only at a mid 7 delta here on this particular trade. So you're only sitting here. We still have a 93% chance that we don't hit that tag, but I now have up here more like a 30 to 35% chance of getting into the trap here. So that's why I like this, doing this a little bit more right now, especially if the markets are bullish, why not shift things a little bit higher, give yourself a little bit bigger chance for the trap. The other thing to do in a bullish mode like we are, if I didn't think we were overextended, which is also where we are, if we pull back inside the 3 ATR, if we drop back to the 21 EMA, I'm bouncing you guys all over the place here. So if I take a look at SPY here, if we drop back to this 21 EMA on here, this is still an uptrend, okay? But you can see this 3 ATR line, the bright white, we are well above that, hitting some new highs here. So we're hitting some new highs, and we're over that 3 ATR here, hitting these new highs as the market continues to just move higher. We're overbought on the daily. We're pretty close to overbought here. It's obviously we're overbought. It doesn't mean that we can't stay overbought for a lengthy period of time, which we know can happen. But if I'm overbought, I'm a little more cautious. I kind of like moving the PDS up, but I don't really want to give up because I think we could pull back, but I'm not looking for a gigantic event down here, in some kind of a black swan. We're in a bullish market. Okay? I would expect a pullback. If we pull back and then start to bounce again, then that's a pretty good sign I mean, it's higher high, higher low, higher high, higher low, higher high, and then hopefully a higher low. And a higher low is anything above 408 here. Could come down to the 50, could come down to the 9. It doesn't really matter. Just another higher high and higher low. If we come down and make a higher low and start to move higher, now it's another pretty good sign that you might want to make another type of adjustment, which I've talked about. Hopefully this is all making sense to you guys. The other adjustment would be to reduce the size, okay, of the trap as well. So instead of 50 wide, sorry, I keep doing that. Instead of a 50 wide, then maybe I would start to look at a 20 wide or a 25 wide, or maybe a 30 wide or something on the trap. And what does that do? Yeah, it shrinks my trap profit, but in a bullish market that's not overextended, I think this type of a trade makes sense. Okay. You could still stay down here. I'm getting 850 now for this thing. If you wanted to, you could actually make it a tad safer and drop it here. I'm still getting 700 on this one on 87.33 in buying power. So this is an 8% version. And I still have a decently high PDS. Okay, it's still above the 25. I'm at like 30 delta. Okay. Does that make sense to everybody? Yes, yes, or yes? I think in a bullish market that's not overbought, and in 2021, this made a lot of sense. So we were in a pretty good bullish market and just a nice, steady, plodding higher uptrend. In that bullish market, thinner PDSs made sense. Okay, and I think it's in the trade plan piece as well, but you can narrow that in more of a bullish market. I would narrow the PDS a bit more on that. So you can start to think about that. If you look at my trading plan, I do account for this. Okay, right down in here. Okay, when we talk about long-term any kind of 112s in a strong bull market, we can go 40 or even 30 wide for less cost to generate more overall income. Okay, I haven't really done it because we're overbought, and I'm hoping, and hope is not a trading strategy. I know that's my own rule, but hope's not a great trading strategy on this, but I think you could certainly start to narrow your put debit spreads right now if you wanted to. I'm going to wait for a pullback because we're overextended, overbought. But if we're no longer overbought and still in an uptrend and things look good, I think I will start to narrow the PDS more if this year is going to be just plodding higher. 2021, it was a great strategy. 2022 was a downtrending year. Okay, now you really want to make sure that you've got 50 wide traps. You don't have to move those up at all, so you can get further away. You're downtrending. You're going to hit the trap, and we hit the trap a ton in 2022. Okay, that's what just propelled our income generation by almost 2 to 3-fold with an 80, I think it's 82% return that year we had in this portfolio, because in a down year, we were just hitting traps left and right, left and right. Well, now comes 2023. Okay, we're down to begin the year. Okay, but then we reverse mid-year and we get into a bullish mode, and you're still not sure, is it a bearish, rally? Is that going to last? Well, it did last, and it's already lasted into January here. But now we're overdone. So I think you have to figure out what's right for you. But I think these types of things make sense to start to look at how can I adjust the sizing of these trades. If we're bullish, maybe we get to 7 delta. I think Joseph, he may go to 8 to 10 delta on it. I see him do a lot of 7s and 8s. Yeah, you want to go up to 10 delta? Knock yourselves out. Okay, if you're okay with it, okay, then yeah, you can drive your way all the way up to to a 10 delta on this thing. But now you're not. To me, I'm a big chicken. Right, so you're only talking 350 points from here. So 350 points down hits my put. and divide that by 400 or 49.52, that's a 7% drop. What did I just say the pullback to the 21 is? The pullback to the 21 is about a 6% drop. We still be in a bullish mode, pulling back to the 21 EMA. That's a 6% drop. This put is now only 7% out. If you go 10 delta, you could hit this put easily on a pullback. Okay. 6% is not gigantic. The market can move 1 to 2% a day. I mean, 3 bad days, you could be at this put. I'm too big of a chicken to do that. But you can certainly be aggressive and do it. And if you get assigned on it, fine. Maybe you don't want to take the loss. Maybe you want to just wheel it and get assigned. You can do any of those things. All right. Hopefully that makes sense. That was a long-winded, maybe explanation of some things, but I just want you to think about how can I adjust my trades? Okay, how do I make sure that that I can do that? So, all right, let's keep going through this really quickly here. I have a long-term 112. I have just the long puts left in this trade. They expire tomorrow, so this hedge will go away. I've got a 60-day hedge, 60 DTE hedge here. That's only got 3 days left. I'm going to lose 2 decent hedges in the next 2 days. So I'll have to keep an eye on that. I have another BA 112 here, kind of the standard one. Nothing to take off yet on that trade. Here's another long puts from a 112. So this has got 17 days. That's a nice hedge. Here's a BA 112 here. This one doesn't have anything to take off, but it gives me good protection to the downside. I've got a February 16th, just a standard 112. We're getting close to potentially taking off this long put or the short put here, but we're not getting close to the naked puts yet. If we take a quick look at this one on the Analyze tab. Okay, so this is the current state of affairs here, where yeah, we got a nice 112. We're way up here. There's only so many days left. Hang on one quick second. I'm going to put you guys on pause for 1 second here. All right. Apologize for that. The benefits of working from home. All right. So one of the things that we can do here is we can close these short puts out of the PDS, and then we can make this thing into a pretty nice big put ratio spread, which we did the other day on one of our other trades. We still have to drop decently to 4,600. So that would be your pullback, but we do have time. We have 17 days. I'm not saying that we're going to drop 6% in the next 17 days, but it does make this a nice trap for the time being until you sell you close the naked puts on it. All right, now you have just a good full black swan-ish type of a hedge here. So you turn it into, that ratio spread, then you turn it into a full hedge on the way down by closing it, but nothing to do here. I'm not closing anything yet till I get to about 95. All right, so that answers that. I got a 112. We got another 112 here. Nothing to do on this March 112. A long-term 112 here. We're getting close to these short puts, and we're getting close here, but we're not there yet. Here's a ratio spread. This ratio spread is up 40% in 20 days. I'm right on the 50, in 30 type of a thing. We'll let these people in. Let's see. So you got a ratio spread. It's okay. It's a little bit ahead of schedule, but I'll leave it for now. All right, just quickly, just running through here. Nothing to do here on this March 112. Here's another 60-day hedge. This thing has 58 days in it. Nothing to worry about there. Another long-term 112. Nothing to do here. A BA 112 down here. Now this one, there's really nothing to do on this at all. 91 days, April 19th. You got another one, long-term 112 here. Here's that. This is an unusual trade that we set up. So we did set up the 1121 trade here. So you get your 1121. We're just testing this thing out. It's doing fine. Nothing exciting. We've only been in it 12 days. We're up 35%. We'll see how that trade pans out. Lots of different ways to adjust that. In it, and then another long-term 112 here. So you've got plenty of those things stacked. Looking at gold, we've got two different expirations of futures contracts in gold. I do have this put credit spread that we put on. Okay. So we did put a credit spread on in gold because it was not a ratio spread. It was a put credit spread that we put on yesterday. Again, I did this mainly because I can't get the buying power I wanted. So I just put on a credit spread, and I went out on this one 60 days and went out to about the 5, still sold the 5. The gold is up a little bit. So I think it was closer to the 7. And I just did enough width to bring in, I believe, 10% on that. Okay, so we brought in $1 on this particular trade. And right now this is up 20% in a day. So not too shabby. We made a little bit of money on it. I will still treat this like any other credit spread that I have, and I'll close that at 50%. Also in gold, we have a 2112 trade on here. We did this a little bit differently. Let's take a quick look at how this thing looks for you guys. All right, so we put this one on, and the reason for this was because gold is so bad from a BP standpoint. I wanted to get a little bit of extra juice and credit on it. And it doesn't really work to buy puts down here to reduce buying power because it reduces your income so much that you can't still get a good payoff on this trade. So what I did with this one was I went way up here, and you can see gold has moved up. If we look at the gold chart, gold has moved up for 3 straight days. We put this trade on 8 days ago. Okay, if you look at gold, okay, here's what gold looks like. To me, gold is in an uptrend. I think this is maybe where Candy and I differed a bit. I think she had gold more of a bearish, in a bearish mode. I kind of view it as a bullish mode, mainly because to me, this is still, higher high, higher low, higher high, technically a higher low, higher high, higher low. So to me, it's still, this is still bullish for me. But it takes 2 to make a market, and then I'm still looking at this longer term trend here. We're still up, but either way. And then when you look at the daily here, this is what I'm looking at. So look, you've had a gap, run, and another decent day today. It's not massive. Okay, so when I look at this gold trade, and I look at how this look how much room to the upside I still have. And gold has, since I put this on 8 days ago, gold has gapped, then run big, and is up again today. And I still have a massive amount of room to the upside. And so gold still has a lot of room up here. So this put, or this call, these 2 calls I sold way up here. I don't love selling calls. It's not my favorite thing, but it's more like a strangle, but I stretched it out. It was just to give me a little more credit on the trade. So it's just being a little creative on the trade. It's really a strangle with a put debit spread inside of it. All right, and then over here, have another strangle on gold that we just put on 4 days ago. This one's down fractionally because gold's been up. So gold's been up for 3 straight days in a row. This strangle's getting touched. It's just the call side that's, it's not close to it. We're 0.300. We're 300 points away. But yeah, the strangle's only 4 days old. There's nothing to deal with there. Hang on, let's knock these out really quick. All right, let's look at copper, another one of my favorites right now. Love copper. And copper's been doing really, really well. It's been in a really, if you watch my videos, I cover every one of these every single night. Okay? And I don't cover them because I got nothing else to do. I cover them because I want to know what to trade. So copper's been in this really nice, consolidating sideways range. And it's broken out of the downtrend, more based on time. It's moving back up. All the moving averages are stacked on it. It's not really a bullish move, but it is. Got MACD running higher, RSI squeeze higher. So the weekly looks good. And if I'm looking at the daily, this looks pretty good. Everything here is stacked to be nice and bullish. We just have this overhead resistance that we haven't seemed to have gotten, we can't seem to get through. And we just keep running into it. Boom, 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 boom. And we run it 4, 5, 6 times. But maybe this time will be different. Who knows? But I really like copper. So I like where copper is here. So we got a 112 trade on. This thing is in good shape. It's 43 days old. And I'm not close to closing any. Well, I am. At 88 and 83%, but I'm not going to do anything with those. Then I also have a strangle on copper down here. And I put this on because these calls were way out of my 3 ATR band level on the weekly. So if we get up to it, we get up to it. There's nothing, I'm not going to worry about it too deeply here, but you get the point. That probabilities are still probabilities. I would like to get something else long on live cattle here. We're just sitting on this PDS for 3 more days till this thing eventually goes away and expires. Then on NASDAQ, we've got a couple trades going here. We've got a 112 trade here. This trade's up 84% in 39 days. So that thing's in good shape right now. And then, excuse me, I'm going to lose my voice. And then we also got a kind of a BA 112 version on NASDAQ. So we did this one the other day. And the reason I did this particular trade, you can never get NASDAQ all in the thing. You can't show the whole thing anyway. But the BA version, I took in almost no income because I wanted a big, giant, you can just go for days on this trap. So this trap is massively long. And we're up here, but we've, pulled back on NASDAQ today. Nice 122 points. Okay, we just need this thing to come down here a little bit more, and life is going to start to be good for us in this particular trade. So we'll keep an eye on this NASDAQ trade, but I like the BA. It's more of a hedge for me to the downside.
Tom, can you please switch screens?
Oop. There we go. All right, so this is you didn't miss much because I can't fit it all in here anyway, but yes. So here is the, thank you for that. Here's the NASDAQ trade. It just goes on forever and ever and ever. So this is the BA. We'd have to drop down. We'd have to drop over almost 3,000 points on the NASDAQ. Doesn't mean that can't happen, but that's a pretty big downtrend. From here, let's see what happens if we start to move down into this trap. So this BA trap was a little higher. We did run up a tad on it, and then we're pulling back. If I take a quick look, NASDAQ is what? That's just been moving sideways for the last couple sessions. So we're just hanging out in here. I'd like to see a drop. I believe it's overdone on the move to the upside. We'll see if it pulls back on me. And then for ZB down here, I've got a 112 trade. That thing's at 157%. This thing's up nicely. so far. The put debit spread is just hanging in there. It's doing okay, and we're up on the long puts. This trade's been on for 25 days. It's doing totally fine. And then we did put a strangle on a couple days ago. This strangle's up 10% in 4 days. So we got a good looking strangle on here. And I really like bonds. You guys know that I probably like where bonds are right now. I think I think the rally was overdone. I think this pullback's been nice, and now I think that we just lounge sideways for a couple months. I think we've already in ZB as in the 30-year. It's not the same as the short-term treasuries of the Fed making moves. So I don't think just because the Fed cuts in March that we're going to see the exact same thing happen in 30-year. I think the 30-year continues to be strong. I think the 30-year hangs in there. I don't see more than maybe 3 cuts this year unless something happens in the markets. So I think the move to the downside was way overdone. Okay, you're gonna, if I forget to switch back, you can yell at me. Okay, I think this sell-off move here was overdone. This thing was way too far done. Down here, a nice little bounce, eased off a bit here, and now maybe some sideways. I just think ZB moves sideways. I think this thing is a perfect strangle opportunity for a while now. I'd like to get more strangles on this particular one. So let's switch back here. Let's see. Okay, I just think that this strangle is a good shape. I think you can keep selling strangles on bonds for a while, and you're way. Okay, this 106 is the low of the year from last year, from like last October. This 133, you have to go all the way back to like April, March of last year to see that bonds even touched it once. And then from there, you got to go back to July of 22 to have hit 133. It doesn't mean we can't. I just think you're so far away. This is a really good trade, in my opinion, from a return standpoint. I think selling strangles in ZB right now is a really, really good opportunity. I can't even fit it all in here. Let's see. Okay, so I think this thing looks really pretty nice in here. You make, pretty good money on this particular trade. And if I look at my tracker, what did I put this thing on for? This is ZB strangle. Okay, I mean, we know it's $2,400 up in here if we land in there, but we spent $12,000 on this. So this is a 20% return on margin at expiration. If we close at 50%, this is 10%. If we can get this thing closed in 30 days, that's a 10% return in 30 days. So I really like where bonds are. All right, so I think I've covered all of my positions with you. I'm going to open it up for some questions. You guys have any questions? And if I didn't hit on something that was in here, can I touch on the small account? Let's actually do that. So let's crank up the small account trades. Okay, so let's get the small account cranked up and let's jump into this one. Okay. All right, so here's the small account here. I'm just using this little strategy builder. Here, but you can see how I constructed my small account. It's tough. I mean, small accounts are tough. I mean, you don't have a ton of things that you can do. But for me, and I played around with this the other day. I think we did this on a live version, but I was allocating 80% to long-term 112s on MES, and I played around with these percentages to see what I could get the best return for my money. I was going to do 15% in some 112s, just some standard 112s, and then 5% into a future strangle, which allows me to only do one contract of probably an ES strangle or something like that. I can spend up to, $400 in buying power, so it's probably an MES. I can do one future, and then I can do about 4 different long-term 112 trades at a time in my small account. So let's go to the small account. Okay, and let's see what this thing looks like up here. So let's switch the screen. Now let's get into the small account, and here's where we are on the small account. And by the way, right now the buying power on this account was about $6,700, so it's at 40% in there. So strangles in 112, but you're lacking the BP of those. So if you're using MES, yeah, I don't know why you'd be lacking BP in a small account. But you can do a couple different things here. So I've got a standard 112 here that has no naked put. So this thing's going to expire in 1 day. Here's a long-term 112 that's going to expire. The naked puts are already gone. So this is really using no buying power. It's just a hedge. Here's another 112 trade that's getting close to closing some of the nakeds, but this is a 112. I do have another 112 on here for February 16th. This one's getting also close, right? Then you have a long-term 112 here that's also getting closer on it. And then another one for that March expiration, long-term 112, April long-term 112s, and then May. So you can see that this account, all it really is a bunch of long-term 112 trades, okay, 1 to 2 a month. Okay, so I can get 2 onto these, or 4 contracts on a month, which was essentially what my plan was to put 4 of these on a month. And then I don't have a strangle, but I do have 2 regular 112s instead, because I don't have a strangle working. The reason I don't have a strangle is the only strangle I can really do is MES. And with the markets being overbought and bullish, I don't really love the strangle on that. And I'd like the directional trade of the 112. So instead of 112 here, I've got really 2 of these working. This is it. So why, it's a boring account that just makes money, right? So this account just going to keep making money. FOMC does not affect any of my setups ever. I could care less what the Fed does. Okay, the Fed only affects the market for about a day or 2 or something like that. I got 90 DTE trades, so I don't really care what the Fed. I am so anti-news. It even in Discord, you guys post, well, someone's doing this or this is doing this. I try not to even read it. It's like one of those things like, okay, it's like looking at an accident. I can't like look away, but I just don't want to know anything about the news. I just want to trade the probabilities of my strategies. And if you may say, well, Tom, how do you know what's going on in the world? I don't care what OPEC is doing. I don't care what someone's doing in the Straits of Hormuz. Okay, I get that a little bit because it leads into my bullish thesis, but it doesn't really, not going to affect my trades because my probabilities are my probabilities, and I try to stay away from that. I do use charts, and to me, the charts a little bit reflect what's going on in the market. I mean, if there's some concern over oil prices, then the oil is going to be going up, and I'll just look at the chart. I don't need to read about something, and I don't think the FOMC is going to do anything for a couple months, so I don't really care what they do. So nothing really affects my setups. I'm pretty news is noise guy, and I don't like news. I try to not read when you guys post anything. So, especially in the ag or the oil or the seasonality stuff, it's all great. But you know what? My trade's still my trade. It's still a 7 delta trade. Okay. It's still got a 93% chance, okay, of probability of profit, or 90% chance probability of profit, whether the Fed implodes or not, because all of that stuff and the anticipation and the volatility is already built into the options pricing. So I try to avoid news. Hopefully that makes sense. Doesn't mean don't post news. You guys chat all you want in there. It's all good. And I know a lot of people really get into that stuff and trying to figure out, hey, there's something's happening in Russia that's going to jack oil prices. Oh, really? If if the news is out there and it's legitimate, options has priced it in. Okay, which means you can go trade anything. Okay, options has technically priced it in, and for the most part, because options Implied volatility is always overstated, and it gets more overstated the longer out in time you go. I shouldn't say it's always overstated. The longer out you go, implied volatility is greater than the realized volatility. And 60, 90, 120 days, that volatility, the implied volatility is up here, and the realized is always here. When you get down to 30 and 45 DTE and 0 DTE, with the exception of the morning open, for the most part, short 7, 10, 12, 15, 20, 45 DTE, volatility is not that overstated. Not like it is when you go longer term. I'm longer term. I'm less affected by daily moves up and down in the market. Yeah, it may turn my trade red for a couple of days, and then we go back to green, because eventually theta would typically win out. Or if something goes to hell in a handbasket, then we stop out and we just move on. You still have the probabilities are probabilities. So MES, this is how I'm setting this up on my small account. You can see it's just all 112s, and I don't think I'm going to close one this month. I think we closed one this month on the small account. We did close a standard 112. Last month in December, we actually closed out this this February long-term 112 here. That got closed out last month. And so there isn't a February long-term 112 to close this month. And this one for March, there's two of them for March. Okay, these aren't ready. They're not ripe yet. So there's no reason to pick these off the vine. So it's possible I will not close a long-term 112 this month in a small account. And it's okay. Next month, I'm assuming that I'll probably close two. Okay, I'll probably close these two. Then this will probably close next month as well. This may close next month as well. I may end up closing 4 trades next month and have a banner month, all at the same time that the small account is also hitting new all-time highs pretty much every single day or two, along with everything else. So we're in pretty good shape in this account, and we haven't really closed anything. If the small account made money with little or no effort, why not use it in the bigger account? Because there's a lot more trades to have on in the bigger account, number one. And number two, I can't make the same return in that bigger account without having some more types of trades on. Okay. I think if you're only shooting for 2% a month, which is now this is the same mantra as the IRA though, Andreas. So in the IRA account, I'm only shooting for 1.5% a month. So it is the IRA trade. Okay, if you guys subscribe to this Discord channel to get my IRA trades, you are probably unsubscribed by now, because there probably hasn't been more than one trade in the small account or the bigger account. Stacy's doing her 25K challenge, which is great. And, she's putting some trades on. But when you're in a small account, you're not taking trades off like 3 trades a week or something like that, because you only have so much buying power. So in a small account, it's just going to be boring and you're making money. The key here is to plow as much money as you can into your small account to get it to a size that you can start to do a little bit more things. I can't trade ES strangles in a small account. It's too big. I can't trade CL in it. It's too big. I can't trade gold strangles. It's too big. They're too big. I only can do some MES strangles and some MES long-term 112s and 112 trade. That's pretty much it. The other thing you can do, and Candy, was probably reminding me of it. We do have a covered call or a covered strangle strategy that we use. I think there's a handful of you still using it out there. It's been a great trade. And if you've been using it this year, or last year, you made nothing but money on that trade all year. It's a really good strategy. I used it quite a bit. We had a 100% win rate. I just had other things to use my money for. But in a small account, I think the covered strangle is a good possibility here. It's a good trade, and I put it on at about 30 DTE. You can, 21 to 30 DTE. I put that on, so you can put that covered strangle on with MES, and I sell around a 12 delta put and about an 8 delta put or something like that. they're usually a certain width. In fact, if you want, we can take a look at what that would be. If I wanted to put one on here, and I do have buying power, you could probably put this trade on in here. So if I wanted to do that trade now, I mean, and we're overbought, and I don't like stuff like this in an overbought scenario. But first one would go here, then about 50 points lower, I'd go about here. So this is what I would put on. This is a covered strangle. Okay. And but yeah, if you wanted to have a account with no effort, you just put your 112s on, and then you just sit back and you chill and you don't do anything else. Okay? If I wasn't in this Discord and probably posting other types of trades and trying to learn and do some other things, I probably would be more boring. Okay? If I wasn't kind of being relied on to put on some trades and keep things going, I probably wouldn't trade as much, and I don't think I'd trade as much as a lot of other people. There's people putting trades on every day. I don't put some days I don't put any trades on. All right, so this would be the covered strangle here. This put here acts as the buying the underlying and selling a covered call at the same strike. Okay, that's this put, and then this is the naked put that goes along with it. So I'm initially entering this right here. You could do this in the small account. Okay. All right, and just using a ton of buying power. 1,700 bucks. I have 1,700 bucks to use in buying power here. So you could put this particular trade on in here, and essentially what would happen is if I get assigned on this one, but not this one, then I will sell another covered strangle on it. Okay, so I'd sell a call up here, I'd sell another put down here, and I just keep doing that until I get called away on it. Or if we drop, I would get assigned on this. I'd own twice as many down here, and I would do it again until I maximize out at probably about whatever my maximum BP is. If my BP gets maxed on 2 contracts, then all I would do is write covered calls after that. But this is how I get in. This is how I get into my covered strangles, is I go down around 12. I'm chicken. Okay. Joseph, he's up here. He's gunslinging right at the money. God bless him. I wish I could do that. I just don't have that stomach to do that, because we're overbought, and that scares the living crap out of me to own anything at the money right now in an overbought scenario. In a good uptrending market like 2021, we were killing it with this strategy, because you just kept going higher and higher, and you could kill it with this strategy. In an overbought or bearish market, this is not going to work. Okay, the same. Okay, doesn't mean it won't work. Okay, but if your account's going down, every single day, and you're writing this, eventually you're going to be writing calls up here for something that keeps falling down here, and you're not going to be getting much premium for something up in here. You're going to get 14 cents or something. But for right now, I think you can't beat it. And I think Joseph's, hats off to him. I think if you guys are watching Joseph's trades, hats off to you. I just can't do it. Okay, I don't think my mouse would let me click on an at the money put to sell. But this strategy I do like. And if you get assigned on both of these, okay, then your average is here. And then again, you can start writing covered calls or writing covered strangles on whatever's assigned. It's a good strategy. I like it. I like what Joseph's doing. I don't have stones he has to do that trade. It's just not something I'm comfortable enough with. Maybe one day. But probably not. I like boring, and I like just making money. He's making plenty of money, so he's doing a great job. All right, I got to wrap up because we're over time here. One more question for LEHGZB112. Are you just looking for 6? Yeah, if you look at my trade plan, that's all I'm ever looking for, is something along those lines of 6% return in 60 days. And so that's the goal of any 112 trade, not the long-term 112s. Okay, but the goal of any trade for me is 3% a month, right? That's my mantra, is 3% a month. If I'm going to put on a 112 trade, I want 3% a month. Well, it's a 60-day trade. I got to get 6%. I'm not going to put it on for less than 6%. Okay, because that won't hit my minimum requirement of 3% a month on that particular trade. So yes, for LE, ZB, HG, I got to get at least 6% return on my money, or I'm not putting a trade, or I'm not putting a 1-1-2 trade on. Or a strangle or anything else. If I can't get it, I'm probably not putting it on if it's kind of a core strategy. If it's a spec trade, I don't really care. Spec trades, you can get whatever. You want to make a trade for $50. You want to do, naked at the money calls every day on MES to make $50 a day. Yeah, you can do whatever you want on a spec trade. But when it comes to like the core strategies of long-term 1-1-2, standard 1-1-2s, strangles, for me, I got to get 3% a month return on the trade. At least that's the goal going into that trade. That's what I want to get on it. If it's a spec trade, like some of these ratio spreads and stuff, I don't really care. I mean, if I make some money, if I make an extra $1,000 or something, great. Okay, maybe that was 6%, maybe it was 4%. But since I'm closing those, since those are 60-day trades, and I can close them out at 50%, which happens roughly in 30 days, I would think that if I put something on for 4%, and I close, or 5 or 6%, and I close it for 2 or 3% in less than 30 days, I think that just adds to the kitty. All right, I hope this was helpful for you guys. Portfolio review, covered some trades. Hopefully this made sense. A little bit of a potpourri of stuff here today, main accounts, small accounts. And if you have got more questions, we'll do this again. And tomorrow, don't forget, we've got in the Discord, we got a little bit of a special treat for all you IBKR members. And even if you're not, but you want to see what some of our members are doing, join us with Timur tomorrow. He's going to be covering the classic TWS platform on IBKR. He's going to show how he does our strategies on it, how he can change settings. He's going to cover how he buys T-bills in the secondary market on it, and he's going to go through his trading strategy. So it'll be really cool to see how one of our members is trading. I'm trying to bring you guys somebody different on a weekly basis, just so you can get a sense of what other people are doing. So check that out tomorrow. If not, enjoy a great rest of your day, everybody. We'll see you in the Discord. Take care. Bye-bye.